So in the second video, we are going to look at incorporating fundamentals into your trading. Now, I've got a number of different examples here, and I know these are cherry-picked, but I just want to get the points across and put it in a way you will understand. It will just be easier for you going forward. So we're gonna have a look at different times and different times in history essentially when fundamentals literally caused massive moves in the market and they caused deep-rooted moves. And if you didn't know these things were happening, you could have lost your account, you could have lost everything sometimes because these moves are absolutely huge. So let's start off with the Euro Swiss franc and what actually happened with the Swiss National Bank abandoning the floor in 2015. So from around October 2011, which is about here, the Swiss National Bank actually said, because they didn't want the Swiss franc to gain strength against the euro, they're gonna buy it up at 120s. So when Euro Swiss franc reaches 120s, as you can see here, I'll mark this out there, the Swiss National Bank is actually going to buy up this level so that it doesn't go below, in order to keep Euro Swiss franc at this level, because they didn't want Swiss franc to be a strong currency essentially, because they are very dependent on exports. You might think, like, why wouldn't an economy want its currency to be very strong? And the reason is, if the currency gets too strong, the value of it becomes too high. So when they want to export things, as I talked about in the first lecture, someone in the US might have to pay more Swiss franc for that product. So this Swiss National Bank didn't want that to happen. So they wanted to continue growing through this export-led industry. So that's why they set out to actually hold the floor at 120. And as you can see here, from April 2012, when the market actually came into this 120 level, it was quickly bought up. And I know it fluctuated in and out some days, but generally from 5th of April 2012 to around 5th of September 2012, for a 5-month period, the Euro franc just didn't move like above this level, because people thought the currency is going to get stronger, and they kept getting, the S&P kept buying up this level. So yeah, that's one thing. So if you didn't even know this was happening, you'd have no idea why the market's doing like this. You might enter the market and go long, yet keep getting stopped out either way, because you just don't know what the Swiss National Bank is doing. And so from September 2012, the market was just allowed to do like what it's doing, and it traded up. It traded heavily into 123s, 124, as you can see here. So let's just scroll across. 2013, the market didn't come down to that level again. 2014 didn't come down again. And then in January, on 15th January 2015, at around 10:30 Eurozone time, the Swiss National Bank came out and said they're abandoning the floor. So many people thought that they're going to keep doing what they did in 2012, three years earlier, where when the market comes into 120s, they're going to buy up again. As you can see, it happened on the 17th of December. The market came in, got bought up straight away. You can see by this candle here. And then when tried to go to the upside, it got rejected and essentially came down into this level again. So on the 15th Jan, many people thought the market's just going to do exactly what it did before. The S&P hasn't changed their mind. They're going to buy up again. And we're essentially going to see a situation like we did 3 years earlier, essentially, where the market's going to trade down here maybe and then just shoot upwards. But then, as I said, at 10:30 in the morning, S&P came out and said they abandoned the floor, and that's when the market collapsed, and many people would have got slipped hard on here. Many people would have lost their accounts because of the slippage. Many people might have had the biggest loss ever, as they would have got margin call strike because of the sheer force of what actually happened. So if you look, I'm going to scroll down in a minute, and so you can just see the sheer force of this candle. So the market on that one day went from 120 to, let's do that 2 seconds. So from 120s, the market traded down, and we keep going, and we keep going, and we keep going, and we keep going, and we keep going to around 96s. So in that one day, the market lost 30% of its value. Euro against the CHF, against the Swiss franc, sorry, lost 30% of its value because of the SNB abandoning the floor. And that was one of the biggest fundamental moves ever. I want to say ever. Don't remember any single move beating such harsh in such a short amount of time. It's absolutely unbelievable. So, and if you didn't notice, you'd have got caught offside going long, and many traders would have lost all of the capital, sometimes because of the sheer size of the slippage and how many pips this actual move was. It dropped from 120 to 9060. So a move of 24 cents, essentially, nearly 30% of the whole value of the currency at that point. So massive move. Moving on. So another big fundamental drive in the market was Brexit Day. So what I'm going to show you here is this is the daily candles of pound dollar in 2016, and if I just scroll across, you'll see how big the actual size of the Brexit Day candle was. So going into Brexit Day on the 23rd of June of 2016, everyone in the UK was actually expecting for Britain to stay in the European Union. And as the news came in that we are actually leaving, it was a massive shock to everyone in the market. And the initial decision was, well, the initial thoughts and speculators was this was very bad for the pound, as we're going to have to establish new trade deals. We're going to have to establish which countries we're going to now export to. And it was, the whole decision to leave was a massive gamble in many people's eyes, and we just didn't know where it's going to go. We still don't know where it's going to go now, as it's just taken years, and there's still no clear pathway regarding trade deals and what form and what terms we're going to trade with different countries. So that's why the pound took a massive hit at the time, which you'll see in a minute. Just look at the size of these daily candles compared to the size of the next candle here. So that's 23rd of June. So 23rd in the night of that, we're going to 24th. Look at that absolute size of the candle here, which I believe was around 2,000 pips, if I'm not wrong. Yeah, 1,800 pips from the top to the bottom. Absolutely huge candle once again. And the market continued to trade downwards after that. So could be argued about, yeah, just around 2,000 pips over 2 days. Just huge candle caused once again by this fundamental reason. So the reason, like, as Britain voted to leave the European Union, it caused this massive move in the markets. And once again, if you weren't aware of this, and let's say you were going long because the market was, to you, the market might have been trading to the upside here, you'd have got caught offside, and you would have got caught big slippage once again. So another fundamental driver, which essentially just changed the whole outlook for pound dollar for years to come after this event. So those are, I know they're very extreme examples and they don't happen often, but they essentially do happen. That's why we are keen on you just staying up to date with the news, like just knowing what's going on in the world in general. Like, it's very important when you're trading the markets, because that's where people are heavily invested in the market. So anything that goes on in the world which could impact their investments will be reflected by the market. So always be up to date with everything that's going on. Moving on, I'm going to show you guys some examples of when there's actually there is pricing in of data. And this is not an easy topic, because it's at the start, it's very hard to recognize when data is priced in, but as you go along, you might start recognizing these news events and why they move the way they do, actually. So, for example, here, going back last year, there was an FOMC meeting on the 16th December, and this is what the euro dollar market looked like running up to the meeting. So we have a nice level of resistance here. You can argue 1 touch, 2 touch, 3 touch, potentially 4 touch. Lovely level of resistance. So we're either looking for the market to come up and reject this again, or actually break through. So we're looking for the market to actually break through, touch on these flows, and continue to move higher. So what did the actual market do? So let's have a look. So you see on the day, FOMC there, it's 8 AM. the FMC is usually at 7 p.m. So at 8 a.m. the market broke through this massive level, and then broke through. We're looking for it to come down. Just go too quickly. So it broke through. As it broke through here, anyone that's selling this market is now out of the market, because if you're selling anywhere in here, where your stop's going to be, they're going to be above this high, going to be above this high, this high, this high there, this high there, these highs there. So what this massive candle has done here is essentially trapped all the sellers in the market, as all the stops have been now taken. And now, what does everyone that wants to long do in the market? Not everyone, but most people. They may be trading the breakout, so they recognize this level of resistance. But as the market broke out this level, and you can see you could argue it's a nice ascending triangle in there as well, just standard retail chart pattern. So what the people who would have traded the breakout here would have done, they would have entered the market with, where would the stops be? So the stops are like to be here, 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 here as well. It's a nice little area of stops, so you can trade the breakout, and the market can go long from here. As we know, around the retest, the market can go long. So what actually happened? So what actually happened on the day? As I said, it was FMC day. Yet there was speculation that the FMC wasn't going to say anything to impact the market, so they weren't going to say anything new about interest rates or potential bond buying programs. So looking at the euro dollar, it was clear that the market wanted to go long from this perspective. As I said here, as we trapped all these short sellers in the market here, but to this big guys in the market, if this long position was just too good, and too many people have recognized this. So when FOMC news actually hit, and we'll see what happens. So this is an FOMC candle. So what does this FOMC candle do? It has now taken the stops of many people going long. As if you went long in this market, you'd have had your stop underneath this candle here, or potentially underneath the previous day low as well. So the market has now took liquidity from all these guys here. And as we took liquidity from these guys here who are short, we now took liquidity from all the guys here, so we're going long. So essentially, the market has trapped traders from two different angles. And as it did this, and the FOMC actually came out and didn't say anything new in the market, so the market was essentially priced in, where many people knew that we're going to see a move downwards just to take liquidity, and after that, the market is just going to continue moving to the upside, and that's exactly what we saw here. So normally, what we'll be looking for is, as I said earlier, the market to have a breakout like it did here, come back and just shoot off from this level, as it's a high level of liquidity. However, with the news, with the high impact news coming out, the market just needed that push of liquidity, needed to trap those traders who actually were trading the breakout or the forced breakout to the upside, as most of the stops, I said, would be underneath this low here, underneath this low there. And this is a situation that does happen often in the markets. And going forward, don't stress about recognizing these moves now. These fundamental catalysts and these fundamental events aren't always going to be so predictable. Going to that FMC meeting, it was close to Christmas, and the markets where there was the vaccination just started coming out, so that's what the markets were awaiting. So they weren't expecting any high impact decisions from the FOMC. So it's clear to see what the market wanted to do essentially on the day. But you'll get to know this decision as we go forward. Sorry. Another example I want to talk about is actually the Bank of England decision from the 4th of February. Yeah. So on the 4th of February, it was Thursday at 12 o'clock. The Bank of England always comes out with the interest rate decision, whether they're going to change it or not change it. So you can see here, you can agree the market's ranging. It's not in a clear pattern from the 20th of January. It's not in a clear pattern. It's clear. It's in a very big range. And this was another example of the market actually pricing the decision, as what we see on the day, if I just keep some coming forward, is look at all these lows in the market here. Got a low there, there. Got all these lows. Look what the market's done. It's took out all these lows. So everyone that's going long in the market there has now been took out, because not everyone, but most people who are going long have now been taken out of the market because the stops are likely to be under these points there. And this was just before the actual Bank of England decision. So the market literally just traded downwards. So many people now speculating that the decision, well, to a normal retail trader, they've just been taken out the market. So they're thinking, okay, the Bank of England must come out with some bad news as the market is moving like this. But what the market did is just flip that on its head. Let me just move this out of the way. As what we see happen, carry on. So that's 11. So look at the next candle here. Bam, straight to the upside. Bank of England came out, didn't change anything, and in that situation, as they didn't change anything, there was no reason for the market to carry on moving lower. What the market just did is it priced in that decision to the upside, and many of these big guys just wanted to get a better price. As now they took out all these stops here, they're entering the market there, and they can push the market higher now as they've got all the liquidity with them. And what we see after that is the market just carries on moving to the upside. And I believe it breaks the other side of the range, if I'm not wrong. Yeah, so you can see market came in, took out all these stops below, and then took out the highs of the range now, and from that point onwards just carries on moving to the upside. So that's another example of the market actually pricing in this big news event, which, just go back, and I believe the move was 80 pips maybe. It's 95 pip move, and the Bank of England didn't actually change anything. It was literally just pricing of these big players in the market, just taking out all these stops of these guys here. So another example of how pricing in can potentially work. Moving on to, so now I'm going to show you guys what can actually happen when there's a big shock in the market. So with big news events. So I'm going to talk about the non-farm payrolls figure from the 7th of May. So if I just move my screen across here, so you'll be able to see. So as you can see here, on the 7th of May, we had at 1:30 non-farm payrolls come in at 266,000 as compared to the expectations of 978,000. So that's a deviation of nearly around 700,000 off the top of my head. Yeah, 710,000, something like this. Massive hit in the market. So to many speculators, seeing this figure, they would have been very scared, and they would have instantly started close out the positions and actually started to short the dollar. So why would they start shorting the dollar? This figure just means that they were expecting 978,000 jobs to come in to be created in the previous month, of the month of April. But what happened is there was only 266,000 jobs that were created. Therefore, there's much less jobs being created in the economy. People's general outlook is now very bleak on the dollar. Therefore, they're going to either exit the market or start short selling the dollar. And what did we actually see happen in the market itself? So news release was at 1:30. Just look at this massive candle in the market there. So as this euro dollar, the value of the euro against the dollar increases, as I said, as many people's outlook on the dollar is now more bleak. 83 pip move just at the news release. But once again, if you weren't aware of this news release and what actually happened, then if you're short this market, because you could have argued if there was a trend to the downside, or you were just shorting the market based on your judgment, you didn't know the NFP figure was coming out, you'd have got stopped at 100%. So it's just knowing these figures can happen and can occur, because it's a massive move to the upside in euro dollar because of the change, because of how bleak the figures actually came in and what people were speculating to happen. Remember, like, the bigger the shock in the market, the bigger the shock in the news that comes out, the bigger the moves in the market are going to be. Where the country is in its economic cycle. So as I said earlier, where we talk about macroeconomic cycles in part 1, So where the country is in its economic cycle as compared to the data release, a good release when an economy is recovering from a recession. So a good data release, such as the NFP figures coming in above expectations, would have caused a big move in the market. Whereas if we're seeing when the economy is in a recession and we're seeing bad news hit the markets all the time, eventually people will start expecting this bad news to happen. As we all know, the economy is in a recession, so people will naturally expect less jobs to be created because we are in a recession. And the same thing happens when you're in a recovery. That's why this big figure here, this big miss in the figures was really a cause of concern. As the economy is recovering, people are expecting these bigger figures to start coming in for these jobs, as more jobs were meant to be created in the month of April 2021 with the vaccination program. And generally, the US economy is starting to reopen again. But as the figure came in at 260, 78,000, 60 or 70,000, let's actually have a look. 266,000, sorry, as the figure came in such below expectations, people started to worry. That's why we've seen this massive candle in euro dollar as people just started exiting the market. So once again, it's just something you need to know going forward and know when these news releases actually are. So to finish off, I'll just talk about the two examples. So we're back again on the daily chart. So this was actually the Corona market. So during Corona, we've seen the value of the dollar rise because dollar is a safe haven. So when there's times of uncertainty, we normally see money flows into the dollar as it's the safe asset, it's a safe haven. Something we'll talk about in risk sentiment actually. So from March 5th of March, 6th of March, when Corona actually started to develop in many more countries around the world now, and there was very high speculations of potential lockdowns going forward. And as these speculation coming in, people started to speculate that the currencies around the world are going to start to devalue. What was that? So as there's lockdowns basically in the economy, people will be less likely to leave the house. As we all know, we're told to not leave the houses anyway, so we can't spend our money going into restaurants, pubs, stuff like this. So we are less likely to drive our cars. Therefore, we've seen this massive crash in oil prices last year as well. So from the 5th of March, sorry, 9th of March, see this big candle there, till 20th of March. So over 11 days, the market actually declined by 7.5%. Which is very, very big for any forex pairs. We're not likely to see the pair move 1% in a day, let's say. It does happen, but it doesn't happen often. And a 7.5% move over 11 days was very big. And it was very clear that we are now entering a very difficult time for many of these economies. So that's what I want to highlight with this decline. Once again, if you didn't know, I know it's stupid to say, but some people wouldn't know how such lockdowns are affecting the economies. So once again, if you didn't know this sort of thing was happening and you were long on this market, let's say, you would have definitely got caught out because of such volatility of this market coming down here. And it's the same across, well, most pairs anyway. This chart on the dollar index would just be flipped over where we've seen actually a massive move to the upside in the dollar as compared to any other pair. So yeah, as Corona hit all these markets, the big markets, big economies were definitely hit very hard. And the last example I want to talk about is the financial crash in 2007 and 2008. So over the period of 78 days, you can see here, the market actually declined. Let's have a look from the peak. So it declined 23% over 108 days, sorry, over 78 bars. So over 108 days, the market actually declined 23%. Once again, a massive move. Financial crisis was a much more deep-rooted issue, sorry, which caused the economy all the economies in the world to suffer heavily. And like euro dollar hasn't traded anywhere near 160s ever since. So you can argue that the economies of the euros compared to the US haven't actually had such strength to even trade anywhere near those numbers. once again, it's a massive fundamental factor affecting the markets and affecting the long-term trends of the markets. Because you can argue if this actually didn't happen, the market would have just carried on trading upwards, and we'd have seen, you could have seen the euro dollar trade at 2 to 1, even 1.7 to 1, but we've never seen that, and I don't know if we are likely to see that. Just seen a massive, ever since that point, the market just kind of traded downwards in this range. So once again, massive fundamental reason. No, like for day trading, it's not a big factor, but these things do happen, and you just need to be aware of these things actually happening. So how do you actually know how to incorporate these fundamental like things into your trading? Like, it's impossible, it's literally impossible to like try and predict such thing as the coronavirus. So we don't know the market's going to dump so hard or the dollar's going to pump so hard. But in generally, when you trade, there's ways you can look at news events and speculate yourself on the outcome of these events. So as I said about the NFP figures we had here, a good thing to do is look into the past and see how these news events have impacted the currency pair in the past and how they've impacted recently. So you can, we use economic FX Street for the economic calendar, as it's really easy to navigate. So let's say I was interested in as I was saying earlier, that what happened, top of my head, I can't remember news release now. So NFP figure from April, let's see. So that would have been the 8th of April. You can just go back to April the 8th, apply. Sorry, it's Thursday, not Friday. So April the 2nd, that would be NFP figure. So US non-farm payrolls came in at 916,000 as compared to 647,000. So when you're back testing, you can look at these figures in the past. So as I found this figure here, I'll now go back into the market. So I'll go back on the euro dollar chart and actually go to that specific day, April the 2nd. So, and actually see, all right, how did the market react? This is that candle. It's on the hourly chart, so this would be the 1 o'clock to 2 o'clock candle. How did the market react? Why did it react this way? Has it reacted this way in the past? Is it likely to react in this way in the future? Looking at the news events, you just really need to. Oh, sorry. Back. You just really need to take these things into account, and going forward, you need to know when they actually are. I know I've been banging on about this stuff, so you need to stay in the know and to follow these news sources which actually mention these releases, such as Economic Street. I know, such as FX Street. Sorry, I know it can be very boring stuff, but you just need to like know what your trading day will look at, what news events will happen in a day which can impact your positions, because it will save you being taken out of the market many times. I'm talking from experience here. Like, it is my best advice to you to actually look into economic calendar every day and stay in the know of these events. Yeah, when you're back testing, have a look at these new events in the past and see how they have impacted the markets. Maybe you can find a pattern where some news events, if they come out to the upside better than expected, the market reacts this way. If they come out weaker than expected, the market just trades the other way, traps traders and trades to the upside, maybe trades to the downside. There's different ways you can play about these news releases going forward, but the main thing I want you guys to take away from this is just knowing when these events happen. As I said, just know when these news events are happening and know what the figures are coming out as, and just watch how the market reacts to these figures going forward, as it will save you a lot of stops being taken. I can promise you that.